The decision to launch an institutional digital asset program is simple compared to the operational challenge of building the infrastructure to support it. Unlike equities or fixed income where decades of standardized industry infrastructure exists, institutional crypto operations require assembling a purpose-built stack from components that are still maturing. The institutional crypto stack has 4 distinct layers: qualified custody for asset security, trading infrastructure for execution efficiency, reporting systems for portfolio visibility and accounting compliance, and compliance infrastructure for regulatory and AML monitoring. Each layer has distinct vendor options, institutional standards, and operational requirements. Weakness in any single layer creates operational risk that undermines the entire program. An institution with excellent custody but inadequate reporting cannot produce accurate financial statements or meet audit requirements. Excellent trading infrastructure without robust compliance monitoring creates regulatory and legal risk that can threaten the program's existence. This analysis provides the implementation blueprint for each of the 4 stack layers, with vendor evaluation criteria, integration requirements, and the specific standards that differentiate institutional-grade components from those built for retail or smaller participants. Qualified custody is the non-negotiable foundation of any institutional digital asset program. Without a regulated custodian meeting qualified custodian standards, investment advisors managing crypto on behalf of clients may be violating securities regulations regardless of the quality of the rest of their operations. The qualified custody layer determines not just asset security but regulatory compliance for the entire program. Trading infrastructure encompasses the full spectrum of execution capabilities: OTC desk relationships for block trades, exchange API connections for smaller trades, prime broker margin facilities for leverage and derivatives, and the execution quality analytics to measure and improve performance over time. The institutional standard requires DVP settlement for all material trades to eliminate settlement risk. Reporting and accounting infrastructure is the most frequently underinvested layer in early-stage institutional crypto programs. Institutions that lack real-time portfolio valuation, accurate cost basis tracking, and financial statement integration discover their gaps when auditors arrive rather than during program design. The ASC 350-60 fair value accounting standard requires specific lot tracking capabilities that generic accounting systems do not provide. The institutional crypto stack architecture must be designed as an integrated system rather than a collection of independent components. Each layer must be able to pass data to the others. Custody events must flow automatically to the reporting layer. Trading execution must update custody records in real time. Compliance monitoring must screen all custody and trading activity continuously, and the reporting layer must export financial data to the institution's general ledger. The integration requirements create significant vendor selection dependencies. Institutions that select a custody provider with limited API capabilities will find reporting integration difficult regardless of the quality of the reporting software. The technical due diligence process must evaluate not just each layer's standalone capabilities but its integration compatibility with the other layers in the stack. Several institutional crypto infrastructure providers are building vertically integrated stacks combining multiple layers under a single platform. Coinbase Prime combines custody, trading, staking, and reporting under a single institutional interface. Fireblocks provides custody, trading infrastructure, and compliance monitoring with extensive third-party integrations. For institutions preferring a single vendor approach, these integrated platforms provide operational simplicity at the cost of some vendor concentration risk. The institutional crypto infrastructure vendor landscape has matured significantly since 2020. In the early days of institutional crypto adoption, most institutions built custom solutions for reporting and compliance because commercial products did not exist at institutional standards. By 2024, a robust ecosystem of institutional-grade vendors exists for each stack layer, enabling institutions to assemble best-of-breed solutions rather than building custom infrastructure. Coinbase Prime has emerged as the dominant integrated solution for U.S. institutional investors, combining regulated custody, institutional OTC trading, staking services, and portfolio reporting in a single platform with established regulatory relationships across U.S. jurisdictions. The integrated approach simplifies operations and vendor management, but creates concentration risk and may not provide best-in-class capabilities in every category. Fireblocks has built a strong position in the global institutional market through its policy engine for transaction governance, which allows institutions to implement complex approval workflows for digital asset transactions. The policy engine addresses a specific institutional governance requirement, ensuring that no single employee can initiate large transactions without multi-party approval regardless of their system access credentials. This capability is particularly important for family offices and smaller institutions with limited internal controls infrastructure. The phased implementation roadmap prevents the common institutional error of attempting to build the complete infrastructure stack simultaneously before any position is taken. The foundation-first approach ensures that custody, basic trading, and compliance procedures are established before scaling capital deployment, limiting operational risk during the infrastructure build-out period. Phase 1 deliberately restricts position size to pilot scale not because the investment thesis requires testing, but because operational processes require testing. The first 90 days of institutional crypto operations inevitably surface process gaps, reconciliation issues, and approval workflow questions that cannot be fully anticipated in design. Testing these processes at small scale allows correction before errors occur at material scale. The transition from Phase 3 to Phase 4 represents the most significant strategic decision in the institutional crypto infrastructure build. Phase 4 capabilities, particularly DoFi integration and multi-chain expansion, require specialized expertise that Phase 1 through 3 operations do not develop. Institutions should make an explicit decision about whether to build Phase 4 capabilities internally or to use specialist advisors and manage solutions before beginning this expansion. The institutional crypto stack implementation failure modes reflect the common pattern of prioritizing investment speed over infrastructure quality. The urgency to begin capturing crypto returns often leads institutions to defer infrastructure investments that seem expensive and slow relative to simply buying Bitcoin and holding it in an exchange account. This underinvestment creates regulatory, accounting, and security problems that are far more expensive than the infrastructure investment would have been. The reporting infrastructure underinvestment is particularly prevalent because the problems it creates are not immediately visible. An institution that buys Bitcoin without proper crypto accounting software appears to be operating normally for months or years until an audit reveals cost basis tracking errors, staking reward misclassification, or fair value measurement inconsistencies that require retroactive correction across hundreds or thousands of transactions. Multi-custodian architecture for programs above $10 million is not conservative risk management. It is the institutional minimum standard following the FTX collapse. An institution that concentrates $50 million in digital asset custody with a single provider and experiences custodian failure has experienced a catastrophic outcome that could have been partially mitigated by distributing custody across 2 or 3 regulated providers. The cost of multi-custodian architecture is modest relative to the risk it mitigates. The institutional crypto stack framework provides the operational blueprint for building digital asset programs that meet institutional governance, regulatory, and accounting standards. The framework is not aspirational. It reflects the minimum operational standards that sophisticated institutional investors, regulators, and auditors expect from any institutional digital asset program in 2024 and beyond. Implementing the 4-layer stack is a multi-quarter operational project that requires specialized expertise, significant vendor evaluation effort, and ongoing management attention. Institutions that attempt to shortcut this implementation by relying on exchange custody, manual compliance processes, or generic accounting software will encounter the specific problems that this framework is designed to prevent. The investment in institutional infrastructure quality pays dividends beyond regulatory compliance. Institutions with mature crypto infrastructure can move faster on new opportunities, scale positions with confidence, add new asset types without rebuilding core systems, and present credibly to institutional investors, regulators, and auditors. Infrastructure quality is a competitive advantage as well as a risk management requirement.